Welcome back everyone, how's it going? This is Spencer with Numbers of Finance, and this is a market wrap video for Monday, April 8th, 2019. Starting off this video, we're taking a look at SPY on the daily time frame. What happened today was really just a continuation of the same patterns that we have been seeing. The market has been very resilient lately. Nobody is really gaining any significant control, but we're kind of just creeping upwards. We've seen a continuation of the trend of increased buying where the markets are crawling up very slowly. Meanwhile, the volume is decreasing, which to me, I take that as a sign that the bulls aren't necessarily in control. It's just so much that the bears aren't present or playing right now. And we're still kind of in this awkward price zone where the market doesn't know exactly what it wants to do right now. We've seen a couple of key levels tested now, the first one being this triple top level at about 282 on SPY. The second one was the reaction high from early 2018. You can't see it, but it was a little bit above 286. And with both of these, they were not really tested or broken with conviction. Although I will say this right now, in terms of price, the bulls do have control over the price. We are a couple percentage points above both of them right now. And so yes, in terms of price, they do have control, and they have put those in the rearview mirror. But there's certainly some stuff to be concerned about if you're on the bullish side. Other price levels to take note of. Ryan has been talking about a additional long-term fib level that is above these highs, but before we get to that point, we do also have to test these highs. And as significant as a point as this triple top was, an all-time high is always going to be more technically significant. And so maybe the markets right now, there's not a lot of volume, and we've been talking about that, and we've seen a continuation of that to open up this week. But maybe before something significant happens, before there's any big jump in the market, any big spike, whether that's pushing up to new all-time highs, or whether it's the start of a third leg down, either way, the markets might want to head up and test this price level before anything happens. In which case, don't expect anything tremendous to happen over a couple of weeks, but that's if the market wants to come up and test these highs. Now the volume, we've been stressing over the volume for a while now about how all these bullish movements are not paired with the volume breakthrough that you want to see. We've seen a continuation of it this day, Monday to open this week, relatively low volume candle day. But again, if you look at this cluster of candles that have been accompanied with this last leg up above the triple top level, relatively low volume compared to what we've been seeing over the past couple of months. Again, it's just another sign of waning momentum. Even though you can't see it, even though it's not showing in terms of the price, it is still very much so there, where even though the bears aren't taking advantage of it, the bears aren't following through with any significant pullbacks to the downside, the bulls right now are just kind of creeping up, and they're not doing it with very strong conviction. And to hit the point home about how the volume is affecting the momentum, it's kind of hard to see if you don't know what you're looking for. But I pulled up this new study. It's volume-weighted MACD, and we haven't used it a lot, but I think it does a fantastic job about showing the picture that we're trying to paint. And that picture is, while the price is going up and the momentum is still drastically heading downwards, and so very similar to the regular MACD, the only difference is that price movements accompanied with higher volume have more weight in how the MACD starts to appear. So back here when we had very high relative volume, the MACD fluctuates a lot more than what you would regularly expect on a MACD, whereas these moves that we've seen in the past couple of weeks that are relatively low volume, they don't move the MACD as much. Again, this does a very good job on all the major indices, painting the picture of how the momentum is vastly in the favor of the bears. So taking a look at this MACD indicator, we can see that on SPY, the divergence is very strong using this volume-weighted MACD. The momentum is sharply heading downwards, and the price is still just creeping up despite there not being any real technical or fundamental catalyst for it. We'll take a look at some other charts. Taking a look at QQQ, I think this one is actually kind of interesting because we haven't actually seen a definitional divergence on the MACD. And what I mean by that is, yes, the price is very much so heading up, and the momentum is not convergent with it. It's not the same. The momentum on the regular MACD isn't saying that the price should continue to be moving up that high, but at the same time, the momentum, you can see it's kind of flattening out here. But if you take a look at the volume-weighted MACD, which I think is very significant in this case, we can see the momentum, taking into account the volume with it, is sharply heading down, which again is incredibly divergent from the price. and is just another sign for the bears, if you're on that bearish case, that we are going to have a pullback and a possible third leg down. But now again, and we keep saying this, and sure, it does sound like we're playing both sides and we're just hedging our bets, but it's the fact of the matter is that the markets really have not been playing out the way that the technicals have indicated. We've had these divergences for weeks and weeks now, and they haven't been playing out. The markets, the bears just aren't present. There's not a lot of forced selling in the markets, and we're not seeing that price being taken down. So the trend that we're seeing is that no matter what, it seems that the bulls are always winning. And so we have to wait. Our sell signal, our macro term sell signal for the bears would come once that trend is broken. So what we need to see is more impulsive selling. We have to see a day or two of significant impulsive waterfall type selling before we actually know that we're no longer in this trend. And a third chart to take a look with this volume weighted MACD that I want to take a look at is XLK. We've been talking about this, and we've talked about how the technology sector might be the sector that will be bringing us down if we are to head down. Vice versa, if we are heading up, it is also likely to be one of the sectors that carries us to new highs. And very similar story to QQQ, where the price is heading sharply up. The MACD was kind of flattening out, where yes, we didn't have the technical divergence, even though you could see that the price was different, or it was moving differently from what the momentum was indicating. But an even clearer picture is painted with the volume weighted MACD. MACD again, continuation of the momentum is heading towards the downside. The price here on XLK is actually getting stalled out up at this all-time high, the 76.27. We've seen 4 days now that looks like where we have consecutively tested that all-time high and gotten rejected. And the more times that you get rejected at it, the more likely and the greater magnitude that a move down will have if it does continue to be rejected. And again, it can break. It's just that right now a good amount of the technicals are saying that it's not likely. And to finish off this video, we'll take a look at VIX, the volatility index. We're taking a look at the daily time frame here, and I just wanted to point out some comparisons between what we have seen in the past and what we're starting to see now. And the thing that we're going to be focusing on are these bullish divergences that we see very clearly. And we've made this point before, but really VIX, it's kind of interesting because all this volatility does is it continually creates bullish divergence over and over again, but it's hard to predict when it's going to play out. So you can see here, a couple years ago, nice, very, not incredibly significant divergence, but the price is heading downwards, whereas the momentum was going upwards. And when it pops in a massive way. You can see this correction, or not correction, but this spike was up 400% in volatility. Likewise, back in 2018, we saw again the price was just slowly declining, the momentum was slowly increasing. It popped. The initial pop over the course of a couple of days was about 150%, but if you go from bottom to top, this is all the way up to the December 26 lows in the market, but that was 220%. And again, we're creating a very similar scenario where the momentum, and this is actually a slightly stronger divergence than what we've been seeing. The price is heading relatively down. It's not a sharp fall off like we've seen in other indices, but the momentum is very clearly heading up. And so again, it's hard to predict exactly when it's going to pop, but we know that when it does pop, it will most likely be a significant amount. And when the VIX, the volatility index, spikes, it does not bode well for the markets. We've seen time and time again when the volatility is increasing that the markets take a sharp leg down. And so I'll leave it there. If you like the video, please leave us a like, comment, subscribe. We're trying to put out the best content that we possibly can. And so any feedback that we get is greatly appreciated. We're not exactly sure what we're going for yet, but we know that we have a passion for this and that we want to continue doing it. And so until next time, this has been Spencer with Numbers of Finance, and make sure you get your numbers up.